Global liquidity, as we suspect, is rising now at a rate of 8 to 10% per annum, which is really simply taken from the growth in government deficits. If that's what's going on, it would double every 8 years. Countries like Saudi, UAE, etc. So what you can see is, as of the end of 2023, the stock of gold holdings among this group exceeded America's gold holdings for the first time ever, right? Now, the more that the dollar goes down against gold and the more that the gold price goes up in value, it itself is devaluing the dollar. Secondly, you've got a backdrop here, which is basically saying, look, China and its friends are accumulating gold. So they're doing something here very significant. And what you've got is a rising gold price. You just extrapolate these trends. Is the US going to stop printing money? No, because the deficit is blowing out. The fiscal framework of the US is...
Global liquidity is rising at an estimated 8 to 10% annually, primarily driven by growing government deficits. This liquidity growth would result in a doubling every 8 years. Regarding gold, nations in the Shanghai Cooperation Organization, SCO, and others like Saudi Arabia and the UAE have surpassed the US in gold reserves as of 2023. With the dollar depreciating due to US monetary inflation and China and its allies accumulating gold, the rising gold price signals a significant shift. Given its worsening fiscal situation, the US is expected to continue printing money. Speaker Michael Howell is known for his insights into central bank policies, debt dynamics, and liquidity flows and their impact on asset classes like equities, bonds, and commodities. Michael highlights the effects of rising global liquidity, most noticeable in fixed income, credit, and forex markets, which react first. Liquidity then flows into equities, commodities, and eventually the real economy, leading to inflation in 2 to 3 years. Asset classes like gold and cryptocurrencies show varying sensitivity to liquidity shocks, with gold experiencing a 15 to 20% increase in value for every 10% rise in liquidity. Cryptocurrencies, particularly in earlier years, showed an even higher leverage to liquidity, but are now stabilizing. In contrast, gold and silver maintain more stable, long-established responses. Due to its long history, gold serves as a reliable hedge against monetary inflation, unlike cryptocurrencies, whose behavior as inflation hedges is still being evaluated. Gold has consistently mirrored global liquidity trends, proving its effectiveness as a monetary inflation hedge. The chart comparison shows that while gold may not perfectly track consumer price inflation, it aligns closely with global liquidity, which better reflects its role in protecting investors from monetary inflation. If you enjoy the video, please give it a thumbs up and subscribe to stay updated on our latest content. Currently, only 20% of our viewers are subscribed. Help us reach our goal of 1,000 subscribers by hitting that subscribe button.
The credit markets and the forex markets are most sensitive to rising liquidity. Then it feeds through into equities. It starts to then hit the real economy. Commodity markets start to rise, and you get this general transmission of liquidity through the economy. And then ultimately, maybe we're talking about 2 years to 3 years later, it may start to appear in faster high street inflation, which is clearly a negative that will then cause central banks ultimately to come back and tighten. So that's really the process that we think of. And in fact, there's a slide which I can show you, which I'll put up, which gives you an idea of the sensitivity of different asset classes to a 10% global liquidity shock. So what that's really saying is that you get these multiplier effects, which is shown on the left-hand axis. So if you're looking at gold, which I know is a big focus of you and your listeners, if you look at gold, what that's saying is that for every, let's say, 10% increase in global liquidity, you're looking at something like a 15 to 20% increase in the value of gold. Silver tends to be more leveraged. But then if you start to look at the cryptocurrencies, what you'll see there are some very, very big responses of cryptocurrencies. I mean, you get the response that you can get 4 or 5 to 1 in terms of the leverage on those, in terms of response to liquidity. Now, it's important to distinguish in that chart the red bar from the orange bar. The red bar is data over a whole period. So we've looked here going back to about 2012, I believe it was, which is using weekly data and using regression analysis to basically show the sensitivity of these different asset classes. The orange bar is the last 18 months. And what you've got with cryptocurrency is obviously part of it's a learning effect. So those responses in the early days were highly, highly sensitive. And now they're coming down to more normal levels. So don't expect looking forward the same degree of sensitivity. Whereas gold and silver, which are much longer established asset classes, seem to have very stable responses. And one of the things that we keep saying, maybe it's becoming more and more obvious to everyone now, is that look, the reason that gold is at an all-time high here is that there's lots of liquidity, monetary liquidity in the system, and that is driving these asset prices higher. Silver will ultimately catch up; it always does. But it's as they label it sort of flippantly, it's the restless metal. It tends to have periods of strong outperformance and then dullness for a long time.
Yeah. Now, since you have that slide up, I do have to ask, because you almost answered that question, but Bitcoin, Ethereum, like how confident are you in that data? It's, as you said, like it's a very short time period that you have a track record of, like the association of of Bitcoin and liquidity, global liquidity. Like how confident are you in that data? And I don't know, maybe a bit cheeky here, but isn't it too early to make those assumptions? I'm curious.
Yes, I think that's right. I mean, I the answer is not so confident. I mean, one would have to say that in all truth, because it's a comparatively small sample. But I'm not an expert on Bitcoin nor on crypto generally. But the point that we've made to our clients is, look, what you see is what you get. You've got to accept the fact that these securities are behaving like monetary inflation hedges. That's what we've seen for the last 10 years. Will they continue to do that? I don't know. Will gold continue to do that? Yes, it will, because gold has got 2,000 or 3,000 years of long-term history of basically protecting investors against monetary inflation. And in fact, if I go on to, I think it's the next slide, it basically illustrates that process. And what we've got here, just for the record,
Michael Howell points out that the post-2000 debt surge, particularly after China entered the WTO, led to significant global debt accumulation, as Western economies relied on debt to manage competition and declining profitability. Unlike equity, debt must be rolled over, not paid off, creating a growing burden. The world holds $350 trillion in debt, with an average maturity of 7 years, requiring around $50 trillion in annual debt rollover. This strain on capital markets means most transactions now involve refinancing, not new investments, with debt rollover outpacing new capital expenditure by a ratio of 3 to 1 or more. As capital markets shift toward debt refinancing, interest rate hikes paradoxically may stimulate rather than slow economies, since bondholders benefit from higher income. Michael Howell exposes the growing need for debt refinancing, which necessitates increasing global liquidity to support balance sheet capacity. Historically, when debt levels exceed around 250 to 260% of GDP, financial crises become more likely due to the difficulty of refinancing in high debt environments. This dynamic underscores the critical connection between debt and liquidity in advanced economies. Let's recall the interview.
I think we need to understand why that trend is going up. Let me just show you a little bit later what's happening to debt dynamics in the US, and we can come back to the challenges for China as well. This is the backdrop for debt worldwide. Now, many people are going to be familiar with this. This is showing how much debt has grown over the period. The reason for singling out China in year 2001, the WTO entry, is that in my view, that was the catalyst that caused the West to start accumulating large amounts of debt, because basically China was a huge challenge. It undermined the profitability of a lot of Western industry. And what it meant was that debt became the solution for many people's problems. And that debt escalation, I think, began around 2000, early 2000s, as that chart indicates. Now, one of the things about debt, which is what this chart emphasizes, is, and this is what the textbooks and what economists don't tell you, is that debt has to be repaid, right? This is not like an equity where you issue debt, an instrument in perpetuity. You've got to roll the debt. And if you issue a 5-year bond, you've got to pay, in theory at least, pay the debt back in 5 years' time. Now, spoiler alert, debt is never paid back. It's rolled over in aggregate. And so what happens is that over that period, you get, as the debt stock increases, the size of the rollover of debt becomes bigger and bigger and bigger. And if you just think of the math, for example, if you've got a $350 trillion debt stock worldwide, which is what we have, and you take an average of a 7-year duration or maturity for that debt, it means you've got to roll over, using simple math, $50 trillion of debt every year. Now, that's a huge ask against the backdrop where global liquidity itself, the stock, is $175 trillion. The world economy in size is about $120 trillion. So what we're talking about here is a vast amount of money that is required simply to roll over debt. Now, what I've drawn up in this chart, which is the slightly scary thought, is that if you look at this, the red line is what we want to see. This is new capital expenditure, right? This is what corporations spend on plant, equipment, building a new chemical works, building a car factory, building, infrastructure, whatever. This is the bedrock of economies and what drives productivity. So that's good. The brown line there is the size of the debt roll each year for the advanced economies worldwide.
Rising liquidity and mounting debt deeply influence the current global financial landscape. Liquidity growth, driven by government deficits and monetary policies, is reshaping markets, particularly gold and cryptocurrencies, while the ever-increasing debt burdens stress capital markets. As debt refinancing dominates financial transactions, the demand for liquidity grows, creating a precarious balance where any disruption could trigger financial instability. Gold remains a key asset in hedging against monetary inflation, while the role of cryptocurrencies as inflation hedges is still evolving. The interplay of liquidity, debt, and asset performance is critical for understanding future market trends. How might central banks adjust their strategies to manage the growing liquidity needs required for debt refinancing? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, watch the video, and turn on post notifications for more videos like this. Until next time.